So thanks everyone for joining us for our second MMI Brown Bag Lunch. We've been holding a series of brown bag lunches during this time where a lot of people are working remotely to share information. And I'm Kirsten Wagner from Modern Markets Initiative. Today, we're really delighted to have on Brian Graff, who's CEO of the American Retirement Association, to discuss 401ks, participant movement, and kind of confidence in the capital markets in the time of coronavirus. So Brian, thank you so much for joining us today.
I'm happy to be here, Kristen. Thank you for having me.
It's really interesting. You have a really interesting organization with a very important mission. Can you tell us a little bit about the American Retirement Association and your core mission?
Absolutely. We're a national organization, and we represent all the people that, sorry, a little tech problem, as I think everyone's having these days, but very happy to be with you and everyone else in the audience today. So we are a national organization of the folks and the companies that work in the 401k industry. All across the country, there are pretty much every financial services company in terms of investments, but there's lots of people that are helping businesses and companies large and small provide 401k plans and other retirement benefits for their workers. So my organization basically represents all of them, about 40,000 across the country.
Well, definitely a very important constituency. And Brian, looking that we're kind of 2 to 3 months now into this coronavirus epidemic and all of kind of the market turmoil we've seen, what is kind of your view on the state of retirement right now versus where we were at the beginning of the year?
You know, I think it's surprisingly really strong. The Employee Benefits Research Institute did a survey they do every year called the Retirement Confidence Survey. And there was some concern, understandably, that there would be more trepidation out there given this current state of affairs around the coronavirus. But I'm pleased to say that Americans continue to feel relatively confident about their long-term prospects for a comfortable retirement. As the situation prolongs, it's possible that that's going to, turn to the negative a little bit more, particularly as more people may get laid off or furloughed from employment. So I think time's going to see how long that impact occurs and whether or not it's going to have a protracted impact on the economy as we're all sort of focusing and thinking about this. But right now, I think there's a lot of optimism around, things turning around.
Right. And I know Congress has done some work on, relief in the 401k space and special loan provisions. Can you talk a little bit about that? And are people are you seeing people take money out of their 401ks right now for that relief?
So the first, there are two things primarily that the CARES Act provided in terms of relief for participants who might need to access their retirement savings because of this crisis. And certainly, listen, there definitely are people out there that are struggling and dealing with, tough situations, particularly, small business owners who've not been able to operate, people who work for folks who aren't able to operate and might have gotten furloughed or laid off. And so Congress decided to make it a little bit easier for them to access their retirement savings in this time of need, which it's done before, depending on the various crises or emergencies that have happened in the past. And the two primary things is, one is a special hardship distribution called a coronavirus-related distribution, and the second is an increase in the loan limits. You can take typically a loan of $50,000 or 50% of your account balance, and now it's up to $100,000 out of your account balance. To date, I'd say about half of employers have taken the option to make this available. So it's not required for employers to do this. It was optional. About half have chosen to do so. But the take-up rate in terms of hardships and loans so far we haven't seen that dramatic of an increase yet, which is good because people, shouldn't be jumping the gun there. This money's for retirement. You should be leaving that in there and only really taking it if it's really, really necessary, which, for some people it will be. Again, this is sort of we're only 6 weeks really into this. I know it seems
Yeah.
like it's been a long time.
Yeah, it
Actually,
does.
8 weeks, I guess, depending on when you started. And so I know it seems like forever, and understandably so. But what we don't know is how, if this continues and how protracted it is, particularly in the ability of businesses to operate. The sooner they're able to operate, people getting back to work, the less likely folks will be drawing down on their retirement savings. But so
You make
far,
a good point. We don't know
you know,
how long this is going to go on.
but so far, I think the usage of those types of tools has been, certainly more than normal in terms of loans and hardships, but not dramatically more.
And Brian, what are you hearing from the retirees themselves? I mean, you represent so many people who are, saving for their retirement. What are they saying to you? What are their concerns that you're hearing? And what are they hoping to get from an organization like yours for help?
So when, my members, as advisors who are talking to when we're talking to plan participants, I think the biggest concern they have right now is understandably around volatility. I mean, you have days in the market where you go from, minus 600 to plus 500. We've seen some pretty significant swings. There's something called the VIX, which is a volatility index tool that's been historically high. And that creates understandable questions about what it means. I think importantly, what we've seen is participants have been mostly staying the course. And I think it's really reassurance that's critically necessary right now. Listen, this is a long-term play. And I think, those are the questions typically we're getting, what's going on with the market, and what should I do? Understandably, and I think almost universally, what you don't want to do is jump and sell low and buy high is not a good strategy.
Right. And I think that's really one of the inspirations for this conversation was this idea of how are we reassuring the market participants, the 401ks, that they can have confidence that the markets are operating and to have that kind of long-term view, which I think you're correct in is really important. And to that end, as we look at, how the markets have functioned over the past few weeks, we've seen, the trading floors close. I know some are starting to reopen, like the New York Stock Exchange soon, which is great. But we've still seen that the markets have stayed open. Even without the floor-based traders, we've seen the markets work fairly well remotely. Do you feel that there's been enough liquidity from the automated traders and the remote kind of traders to power the markets that you've had confidence?
Absolutely. I mean, I think what's been extraordinary is how seamless the market has operated in this crisis. I mean, almost not missing a beat at all. And I think, our investors, 90 plus million Americans who are primarily investing in the market through their retirement plans, should have confidence that the markets are working just as they always been, efficiently and fairly for all investors. And I think that the market has definitely reflected that. So people need to recognize here that the markets are operating just as normal. Don't worry about things from that perspective. This really isn't a financial crisis. This is a healthcare crisis, and I think there was at least initially people trying to make comparisons to the financial crisis of 2008 and 9, and that's not what's going on here. The financial markets are strong and solid. It's unfortunately a healthcare crisis that's scary and having an economic impact because of the restrictions we're having to put in place to fight off the virus, but it's not a fundamental financial crisis like we had before.
Right. And when you talk about kind of the volatility in the markets, can you talk a little bit about what the role is of liquidity? Is liquidity especially important when there's volatility so 401ks can continue to rebalance this notion?
Absolutely. And target date funds remain the most common and largest, holder of assets of all retirement plan participants today, and there are good reasons for that because they represent an excellent way for 401k investors to kind of have a glide path as they're going from their working lives towards retirement, and target date funds are designed to do that. And frankly, they're trading every day to keep up with what's happening in the marketplace, to make sure that balance, depending on what age you are and how close you are to retirement, is maintained. And so liquidity is crucial, and people should know that all of that trading that goes on every day within those funds are continuing without a hitch.
Right. And that's really one of our core messages at Modern Markets Initiative, is the importance of dependable liquidity in these times, so investors can have confidence whether they're investing in a target date fund or other, retirement strategy. I did notice you have a really interesting kind of young guns ranking of some of the top advisors under 40. Do you have any trends you're seeing on the future leaders in the industry? What are some trends to watch that you are looking out for?
Listen, we're really excited about the enthusiasm and the vibrant nature of advisors who are getting into our space, the 401k space. I think a lot of it has to do with millennials and younger folks who are very interested in kind of giving back and helping people. And being a 401k advisor is a great way to do that, because you get to touch so many more people than you would in a wealth practice. I mean, with a wealth advisor, I don't want to minimize the value of that, profession, but the reality is you're probably dealing with 40 clients, maybe 40, 50 clients. Maybe if you've got a huge practice, you're getting beyond that. But a typical 401k, successful 401k advisor is touching tens of thousands, sometimes hundreds of thousands of people, in doing enrollment meetings, education meetings, and doing participant meetings. And what the feedback I get is how 401k advisors will tell stories about how they're helping a single mom figure out a budget and get to the point where they can start saving, and how rewarding that is. So 401k advisors make a difference. And I think that's what's drawing outstanding folks to the profession.
And in addition to the young guns, I see you have kind of a list of some of the top female investment advisors. What are you doing on gender kind of work? I know overall, not in the 401k industry, but generally, like, women are less likely to save retirement than some of their men. Are you seeing that trend starting to change for participation of women, whether it's in investment advising or in participating in retirement plans?
Sure. No, I mean, definitely there's a gender gap in retirement, just like there's a gender gap in income still. And part of it is related, obviously, in that women, because of that income gender gap, there's less money to save. But there's also accessibility issues too. A lot of women tend to work on a part-time basis, but they continue to work on a part-time basis because perhaps it's from a workload standpoint, they've got responsibilities at home with kids. And so we pushed very hard for recent legislation that was enacted at the end of last year and will be implemented next year to provide much more accessibility to 401ks for those women who are what I describe as more permanent part-time workers, right, who previously would have been not eligible for a 401k, now beginning next year will be.
That's really great work. I just think you've done such an impressive job with the young guns and the female investment advisors. You just seem like a really diverse group of initiatives. Stepping back again to kind of investment strategy, you mentioned earlier that portfolios were continuously being rebalanced for target date funds. Can you talk a little bit about, if you're just a retail investor investing in a 401k, do you see a greater trend to like ETFs, index funds, to diversify risk exposure over kind of individual stocks? And does that mean kind of more rebalancing for those investors? Can you talk about some of those trends?
Yeah, well, so the trend definitely, very few on a percentage basis, 401ks offers what we call SDBAs, self-directed brokerage accounts. The vast majority of 401ks are institutionally managed. I think the trend line right now is kind of this battle that's happening between more traditional target date funds, which are mutual fund to funds, of mutual funds and towards managed accounts. And that trend is accelerating. I think, what's happening economically now is probably going to accelerate that. And you'll see more of a movement towards managed accounts, which are similar or very akin to target dates, as they're designed to reflect the needs of the particular participant, but they will tend to use CITs or ETFs or other types of vehicles as opposed to a traditional mutual fund.
And are there any other 401k kind of trends that we should be aware of that are happening now during the coronavirus time or otherwise that you're flagging kind of overall?
Absolutely. I mean, think about how financial wellness is so critically important right now, and how people are sort of dealing with this crisis and having to rethink, economically, what's happening. Even those who are still fortunate to keep their job, most businesses are being impacted one way or the other. And so, folks are having to assess things. And this is a great time to be, thinking from a wellness standpoint, making sure that you're addressing budget issues, dealing with credit card, balances, and making sure that you're, positioned to continue to be able to save for retirement. And so you're more and more, you're going to see 401ks paired with effective financial wellness tools to make it easier for folks to look holistically about their financial situation, including how much they're putting in their retirement plan.
So when you say financial wellness, there's kind of one platform where they look at the retirement savings plus other baskets of maybe debt to credit card holders or other financial obligations, and it's a kind of a 360 picture?
And that's exactly how my industry is approaching things now. I think for a long time, we've been seeing our business or viewed as being in the plan business, and it's really transforming into a participant business. And so what that means is, looking not just at their 401k account, as you suggest, but holistically their entire financial situation, and approaching the relationship between the advisor and the participants in a more global way, rather than just focusing on what's in their 401k account. So they can do a better job through managed accounts or other means in terms of what makes most sense for them based on other assets they may have outside the plan.
And what are you hearing from kind of the younger generation of millennials on this? Is there different hooks for investing for kind of younger generations versus, some of the baby boomers?
So I think a trend that's just starting in I think generally in the United States, but certainly just starting in the institutional side, the 401k side, is ESG, environmental, social governance. I would expect certainly that trend line to accelerate quite a bit. I think it'll accelerate quite a bit more depending on how the election goes this fall. And so we're spending a lot of time, focusing on that subject. I'm spending a lot of personal time focusing on that subject because I think there are elements to it that I think some people are concerned about, but I also think there are elements to it that are actually pretty exciting and that could make 401k investing for younger folks much more meaningful.
So there's kind of a social impact element as well as just an emphasis on sheer returns over time.
Correct.
That's
and what we have to be careful is not substituting one for the other. They
Right.
have to be paired together. We can't, there are legal requirements in ERISA that require principally the fiduciary's responsibility is to ensure the benefits of the participants, and that includes making sure that returns are essentially maximized, and we can't substitute social impact for that. But I think that the trick's going to be, and I think a lot of the focus and energy is going to be, how can we do both, right? How can we create a large cap fund that's focused on things that younger people cause, environmental causes, other causes that younger people are excited about, but still maintain the quality of investments.
And I've seen apps advertised on television for kind of investment strategies where people can, round purchases to the nearest dollar increment to add to retirement plan accounts. Have you seen much of that? And I think some of it has been in the crypto space, and there just seemed to be so much.
Oh no, I mean, there's
is that something you're seeing? Yeah.
Yes, I mean there are ideas like that on the retail side, but also on the institutional side being developed. In fact, there's a company that is developing something that would create a point system. Like instead of getting, airline miles, which maybe people are less interested these days in getting airline miles, they get extra dollars essentially contributed to their 401k account or IRA.
Well, it's just exciting. It seems like so many retirement strategies have really been democratized because trading is so cheap. We're seeing near zero fee trading right now, and that must be shaving off the cost from a lot of the 401k standpoint. So it just seems like we have some of the least expensive markets ever where people are able to get the biggest bang for buck for the dollars they're putting in. It seems like there's been, at least to me, the historically lowest transaction costs in history, right?
401k fees, like retail investing, has dropped dramatically for various reasons. And I think there's a regulation that's going to come out, could be this week, but certainly very imminent, that will finally allow for all of the disclosures that we have to send out that are still going out by paper, like quarterly benefit statements, to finally be able to be delivered electronically. And believe it or not, it'll save the 401k system somewhere between $300 to $400 million a year. That's, think about it. We're sending 100 million benefit statements 4 times a year, and sometimes they're like multiple pages. So think of just the environmental cost of that.
Saving some trees too.
We are saving some trees. So
we've been on such an interesting trajectory of cost savings for investors. I know, at least from automated trading, that the bid-ask spread has shrunk by half over a decade. So that's real money for people, and lowering the cost of getting these different statements is also really just promising news for investors. It's real dollars in their pocket. Looking ahead kind of to the elections, I know there have been different political plans for a financial transaction tax, which I think many people consider as something that would increase the cost to investors and kind of set back some of the progress we've made that you're talking about. Can you talk a little bit about your thoughts on, I know the financial transaction tax has not received mainstream support yet, but we're looking out for it. What are your thoughts on this proposal?
Well, it's kind of ironic that with all the discussion, including what we just talked about in terms of focusing on fees, we as an industry, the 401k industry has taken quite a lot of criticism over the years about fees that is deemed to be unnecessary. When we're at a point where I think it's very fair to say that our fee structure has gotten the most competitive it's ever been, and frankly, to the point where there's very little waste in the system at all. That you've got certain members of Congress saying, okay, well, now we can start taxing 401k savings and start assessing a 10 basis point or as much as a 50 basis point tax on trades within all investments, including retirement plans. And so we're very, even though it's not getting a lot of attention right now, because frankly, nothing's getting much attention right now, given what we're all dealing with, we are concerned, like you are, that depending on the election, this is likely to come up next year as a real proposal that's taken very seriously.
And you noted earlier, Brian, the target date funds, that they're continuously rebalanced. We see a lot of the products like ETFs, index funds, that are continuously rebalanced. So it's not that this tax would be assessed once when a person moves into their 401k account and then they get out, right? Can you talk about how frequently? Would it be each time it's rebalanced, or what?
Every impact, right? Absolutely. Every single day you're paying the tax. Every day, if you're in like I said, the most typical investment still is target date funds, but if it's a managed account, whatever it is, any mutual fund, there's internal trading that goes on every single day, and it's going to substantially increase the cost of those investments over the participant's lifetime. In fact, my friends at the Investment Company Institute did an analysis, and their estimate that the average target date fund their fees would increase by over 30%. So at a 10 basis point financial transaction tax, that's over the year, basically increasing the fees for the fund by 20, 25 basis points. And that's not, given all the attacks about how much, investment fees are, to add a 25 basis point, essentially tax on people's retirement savings is really significant.
So this is in essence a retirement tax and a savings tax. From what I'm understanding, it would hit not just 401ks, but 529 plan participants, which is half of Americans, ABLE plan participants who are saving money for their disabled children or dependents, really a broad swath of participants.
The big defined benefit programs for state and local workers that are currently, really underfunded. I mean, if you go to certain states in the country, some of those plans are, 80% or more underfunded, and now they're going to be paying a tax. And so everybody's savings is impacted by this. This notion that it's been, has been described by some of the proponents of this, that this is a Wall Street tax, is completely bogus. It's a Main Street tax. And it's gonna impact every working American, and it's gonna require them to work longer to catch up on the savings they're losing. And there's also this notion that somehow, this tax is going to magically increase market values, which, the idea that a tax is going to increase market values is an oxymoron to start with.
And do you have a concern, if you're a retired school teacher or policeman or just anyone who's saving for retirement, I know some people have been worried about volatility, and in some jurisdictions where the financial transaction tax has been tried out, there's actually been increased volatility. Do you see any reason why a financial transaction tax would reduce volatility in the markets?
There's absolutely no basis for that whatsoever. I mean, it's a tax. It's the amount of it's the rebalancing that happens is happening because there are investment policy reasons for doing so. It's not going to be going up or down. Right. That those transactions in terms of frequency are not going to change as a result of a tax or not having a tax. All you're doing is adding a layer of cost and sending money to the government that is draining your savings.
Well, I have one last question for you. I know you don't have a crystal ball for the future, but if you were to kind of give
If I did, I wouldn't be here because I would be making all this money.
Yes, exactly. But if you were to just give one last bit of advice to folks who are invested in 401ks or saving for their retirement future, or even people saving for college, what is the last bit of advice you'd give to them right now as they're seeing all these headlines with the coronavirus and everything? What would you want their key takeaway to be for them?
Hang in there. I mean, listen, everyone went crazy and got really, understandably concerned, around March, third week in March, when it looked like hopefully the market bottomed out in reaction to this, and that was a market overreaction. And don't buy into the overreaction. Retirement savings generally should be viewed as long-term savings, and stay the course. And look what happened. You had a great day yesterday, and the market continues to rebound from that low point towards the end of March. And if we continue to march towards reopening the country, I think the market will continue to rebound. And the point being that you've got to look at the long-term view. Don't look at, don't get sucked into what's happening on a day-to-day basis. You might get a little bit dizzy, and it's not necessary, because you're a long-term investor, you're a long-term saver, and in the long run, the best thing you can do is stay the course, and you will be rewarded for it.
Well, Brian, thank you so much for joining us. And I think this is really informative and helpful. And we can feel more confident in the markets talking to you and getting your perspective. So thank you so much. I hope everyone else enjoyed this webcast with Brian Graff, and we will be posting this online. And you can follow us at Modern Markets on Twitter. We'll be posting that on social media as well. So thank you, Brian, and I hope you stay well with your family.
You as well. Thank you so much. And everyone, please stay safe.
Great. Thank you.